Usually when we talk about the Federal Reserve, there's this expectation of just extreme, almost boring predictability.
Oh, absolutely.
Right. I mean, the Fed acts like a GPS. You get a notification months in advance, like turn left in 100 miles or, cut interest rates by 25 basis points. The path is totally mapped out and the market just blindly follows along on autopilot.
Yeah, we've all grown incredibly accustomed to that certainty. For the last decade, we've basically demanded that central banking be, well, perfectly telegraphed.
But looking at Kevin Warsh's recent 2.5-hour Senate Banking Committee hearing, this is for his nomination to lead the Fed, it feels like he wants to just rip out the GPS entirely.
He really does.
Instead of flying on autopilot using coordinates programmed like 6 months ago, Warsh wants the Fed flying manually, reacting to the weather right outside the windshield.
It's a massive structural overhaul. I mean, we are looking at a fundamental regime change in how monetary policy is actually conducted.
So today, we're skipping the fluff. We are diving straight into this massive cache of real-time market data, the hearing transcripts from April 21st and 22nd, 2026, and all the latest institutional analysis from places like CNBC, Reuters, WSJ, Seeking Alpha, and Invesco.
There is a lot to get through.
There really is. We're going to decode why Warsh's radical new hawkish dove stance on artificial intelligence might actually be the secret weapon to saving your tech portfolio and, how you can navigate the severe market turbulence that's heading our way next month. Okay, let's unpack this.
Right. So before we can map out how Warsh's future policies will impact your tech valuations, we really have to establish his baseline philosophy.
Which is pretty intense from what I've read.
Very. And that philosophy is entirely built on his blistering critique of the Fed's recent past, specifically how he's positioning himself against the current political pressures in Washington.
The political backdrop is just a pressure cooker right now. There's intense, very public pressure from Donald Trump regarding exactly where interest rates should be.
Oh, yeah. Everyone is watching that dynamic. Yeah.
But reading through these hearing transcripts, Warsh is basically casting himself as the strict referee who refuses to even look at the sidelines. He told the committee point blank, and I'm quoting here, "Fed independence means everything to me, and I will be an independent actor if confirmed."
He was aggressively pressed by senators on both sides of the aisle about whether he would bend to political will, and he didn't give an inch.
Not a single inch.
And this goes deeper than just standard, confirmation hearing posturing. Warsh operates on this core belief that inflation is a choice, and the Federal Reserve must take absolute responsibility for it.
Meaning no passing the buck.
Exactly. In his view, Congress tasked the Fed with price stability, and there is zero room for blaming external factors.
And he made it very clear where he thinks the Fed made excuses instead of taking responsibility. He went right after the policies of 2021 and 2022.
He really did not hold back.
No, he called the loose monetary approach of that era a fatal policy error. I mean, that is a brutal assessment of his predecessors.
It's basically unheard of for an incoming chair to be that blunt. He attributes the massive 25 to 35% spike in inflation directly to that specific era of money printing, right while supply chains were blocked.
Wow.
And he emphasizes that we are still paying for the compounding consequences of that error today.
Let's translate that for the listener because sticky inflation is a concept that gets thrown around a lot on financial news.
Sure.
Warsh is essentially saying that once you let the inflation genie out of the bottle, once restaurants raise their menu prices and workers demand higher wages to pay for those menus, it becomes exponentially more expensive and painful to force those prices back down.
Spot on. And that is why his framing matters so much for anyone holding an investment portfolio right now.
How so?
Well, he's signaling a complete permanent departure from the era of central bankers calling inflation transitory or, blaming global shipping delays. He's trying to establish a strict long-term framework where accountability is literally the only metric.
Wait, but this is where the logic starts to break down for me.
Okay, where are you getting stuck?
If he's so deeply terrified of inflation returning, and he thinks the 2021 policies were a fatal error, how does he justify the rumors that he's planning to lower rates? It sounds like he wants to slam on the brakes and the gas at the exact same time. How is he not contradicting his own strict framework?
That paradox is exactly why Wall Street analysts have slapped him with this bizarre label, the hawkish dove.
Which sounds like an oxymoron.
It totally does. At first glance, cutting rates while claiming to be an inflation hawk makes no sense. But the linchpin holding this entire economic theory together is artificial intelligence.
Okay, when I hear that, my mind immediately goes back to Alan Greenspan in the late 1990s.
Yes, perfect comparison.
We had that massive personal computer boom, PCs made offices wildly efficient, overhead dropped, and corporate profit margins just exploded without companies needing to raise prices on consumers.
You've hit the nail on the head. What's fascinating here is how that 90s technology-driven productivity boom meant the economy could grow at a blistering pace without triggering inflation. The efficiency naturally suppressed prices.
And Warsh sees AI doing the same thing.
Exactly. He believes the current AI revolution is going to trigger a similar, perhaps significantly greater, productivity boom right now.
Let's make that mechanism really concrete for everyone listening. Imagine a software company today that uses AI agents to replace a massive, super expensive coding and customer service department.
Right, their operating costs would just absolutely plummet.
Exactly. Because they are spending way less to run the business, they don't have to raise the price of their software subscription to maintain record profits. And if you multiply that across thousands of companies, you have massive economic growth with flat consumer prices.
That is the exact macroeconomic phenomenon Warsh is banking on. He views AI as a, quote, significant disinflationary force.
I see.
In the hearing, he used a very specific phrase. He said the Fed needs to learn to sit on its hands.
Meaning, don't intervene just because the economy is running hot.
Right. If AI is naturally driving prices down through massive corporate efficiency, the Fed doesn't need to artificially crush consumer demand with sky-high interest rates.
Right.
They can afford to just be patient.
So his faith in the tech sector is what gives him the theoretical cover to be dovish on short-term rates. He can cut rates to fuel business growth while maintaining his hawkish reputation, all because he expects AI to do the heavy lifting of keeping inflation anchored.
It is a brilliant theoretical balance.
Yeah.
But leaning on AI to suppress inflation is really only half of his proposed regime change.
There's more.
Oh, definitely. Because he believes the underlying mechanics of the economy are shifting. He wants to fundamentally rewrite how the Federal Reserve operates on a day-to-day basis.
Right, he wants to kill the script. In the hearing, he kept hammering this idea of a regime change in the conduct of policy.
Yes.
Which brings us back to that GPS analogy. He wants to destroy forward guidance and those famous dot plots.
The dot plots have been the ultimate security blanket for Wall Street for years.
Oh, absolutely.
Fed officials have anonymously projected where they think interest rates will be months and years into the future. Warsh explicitly called them unhelpful.
I can honestly see why. I mean, if you tell the market in January that you are going to cut rates in June, you've painted yourself into a corner.
Exactly, you're trapped.
By May, the inflation data might look terrible, but the Fed feels trapped by their own forward guidance. They might make the wrong macroeconomic move simply to avoid spooking a market that totally expects a rate cut.
And Warsh hates that trap. He embraces a framework that he actually describes as more messy.
Messy. That's not a word you usually hear from central bankers.
No, it's not. He wants the policy meetings to be arenas for fierce, real-time debate based on whatever the data looks like that morning, rather than just adhering to some predetermined timeline.
Which means less central planning and more reacting to reality. And this manual flying approach includes a highly unusual mechanical shift, too. The analysis from our stack shows he's looking at cutting short-term interest rates while simultaneously accelerating quantitative tightening.
Yes, shrinking the Fed's massive balance sheet. Doing both simultaneously is a very novel approach.
It sounds counterintuitive.
It does. Normally, if a central bank cuts the Fed funds rate, they're trying to pump liquidity into the economy. Shrinking the balance sheet does the exact opposite. It drains money out of the financial system.
Let's break down how those two forces interact, because to me it sounds like they should just cancel each other out.
Well, they impact completely different parts of the economy. Cutting the short-term Fed funds rate provides immediate relief for consumer loans, credit cards, and small businesses.
Right, it keeps everyday commerce going.
Exactly. It keeps the gears turning. But accelerating quantitative tightening pulls massive amounts of institutional liquidity out of the bond market.
So he's offering a lifeline to Main Street while sort of turning off the liquidity fire hose for Wall Street.
That is a very accurate way to visualize it.
Right.
Warsh argues this dual approach restores true price discovery.
Let's make price discovery tangible for the listener. Over the last decade, interest rates were near zero. Money was virtually free.
Almost entirely free, yeah.
Because cash was so cheap, we got these zombie companies' businesses with terrible fundamentals that could survive just by taking on more cheap debt.
We saw a lot of that.
So Warsh is essentially saying that by shrinking the balance sheet, capital becomes scarce and expensive again. The market is forced to actually punish bad companies and reward innovative ones.
Yes, he wants dollar scarcity.
Yeah.
He wants investors to evaluate risk accurately instead of relying on an endless supply of cheap capital to just bail them out of bad investments.
As a quick aside, the hearing transcripts show he's at least acknowledging how the financial landscape has evolved while the Fed was pumping all that cheap money. He flatly stated that crypto is, quote, now part of the U.S. financial system.
Yeah, looking at the real-time reactions on X, that single sentence sent a massive wave of positive sentiment through the whole crypto community.
He also committed to divesting his entire net worth, which is estimated somewhere between $135 and $226 million, within 90 days of confirmation to avoid conflicts of interest. So he's clearing the deck.
He is clearing his personal deck, certainly. But the mechanics of actually getting him into the chairman's seat are currently jammed up.
This is the drama part.
Yeah, this is where the theoretical policy discussion just crashes straight into brutal political reality.
If the safety net of cheap money is disappearing, the transition timeline becomes the most important metric for any investor listening. Current Fed Chair Jerome Powell's term officially ends on May 15th.
Right.
We have this grueling 2.5-hour hearing finished, but Warsh isn't getting the keys to the building yet, is he?
Not at all. The confirmation vote is stalled out. Republican Senator Tillis is actively blocking the vote on the Senate floor.
And the reason why is just wild.
It really is. He's demanding that the Department of Justice first wrap up an ongoing investigation into the recent, highly controversial renovations of the Federal Reserve headquarters under Powell's leadership.
I mean, you cannot write this kind of script. A DOJ investigation into office renovations is literally holding up global monetary policy.
It highlights the friction of Washington perfectly. But more importantly for retail investors, this delay likely pushes Warsh's confirmation vote into late May or even June, which is well past Powell's official exit date.
Meaning Powell might be forced to stay on as interim chair just to keep the lights on at the central bank.
If we connect this to the bigger picture, the analysis from Seeking Alpha isolates this specific transition window as a period of severe near-term turbulence. Markets absolutely despise uncertainty at the top of the global financial system.
Especially when the incoming guy has publicly promised to kill the Fed put.
Oh, that's the big one.
Let's define that, because if you're listening and managing your own 401k or stock portfolio, the death of the Fed put changes the fundamental math of your investing.
It completely rewrites it. The Fed put is the long-held psychological safety net for Wall Street. For decades, investors have operated on the assumption that if stock prices start falling rapidly, the Federal Reserve will panic and step in to rescue the market by slashing rates or injecting emergency liquidity.
It's basically an unspoken insurance policy. Like, if my stocks crash, the Fed will bail out the market.
Right.
But Warsh's entire philosophy of price discovery means he won't intervene. The safety net is being pulled away right in the middle of a delayed, messy transition of power.
And that combination of a vacant or interim chair, a blocked confirmation vote, and the looming threat of a central bank that refuses to rescue falling asset prices, that is just a recipe for high volatility.
If that safety net is gone in May, my immediate thought goes straight to my portfolio. Tech valuations are priced for absolute perfection right now. The Nasdaq has been on an absolute tear.
It has.
How does removing the Fed put, combined with this Washington drama, not trigger an instant, massive Nasdaq sell-off?
The institutional consensus is actually pretty surprising here. The probability of a systemic Warsh-triggered Nasdaq crash is currently modeled at under 30%.
Wait, under 30%? If he's pulling the safety net and promising dollar scarcity, high-growth tech stocks should be terrified. Why the optimism?
You have to look at the other side of his policy framework. Remember that hawkish dove dynamic we talked about?
Right, the AI stuff.
Exactly. His entire justification for eventually cutting rates is built on the premise that AI is a massive disinflationary productivity driver. That narrative doesn't threaten tech valuations. It actively validates them.
Ah, okay. If the incoming chairman of the Federal Reserve is sitting in front of Congress telling them that tech companies are so innovative they are going to single-handedly suppress global inflation, he's basically cheerleading the entire sector.
He is providing the ultimate institutional endorsement for AI capital expenditures. If you look at the market data from April 21st, the actual day of this marathon hearing, the reaction was incredibly subdued.
How subdued.
The Nasdaq, the S&P 500, and the Dow only dipped about 0.6%.
And digging into the market internals for that day, that 0.6% drop wasn't even entirely about Warsh. The tape shows that the minor dip was heavily influenced by breaking geopolitical news out of Iran and a sudden Apple CEO transition announcement happening at the exact same time.
Right. The market simply did not panic at the prospect of his economic framework.
So how should a growth-oriented retail investor actually navigate the next month?
Well, that is the million-dollar question. Do we buy the dip, or do we brace for impact?
The actionable takeaway from the sources seems to be to prepare for what analysts are calling an unpredictability premium.
Yes, that's exactly the term they're using.
Because of the confirmation drama with Senator Tillis, the DOJ investigation, and the high probability of public clashes between Warsh and Trump over Fed independence, we're going to see 1 to 3% short-term volatility swings. The market will react to every single headline.
So we are looking at a very bumpy ride through May.
Definitely. Expect turbulence. But the strategy for growth portfolios is to look past the transition noise. Don't panic sell your tech holdings just because a confirmation vote gets delayed again. Instead, focus on the structural, long-term tailwinds that Warsh's policies provide.
Because if AI actually delivers on the massive productivity gains he's predicting, and he cuts short-term rates to support that growth, the environment becomes incredibly bullish.
I saw that in the data.
The long-term projections we pulled from the institutional analysis still forecast the Nasdaq hitting 30,000 plus by the end of 2026.
His framework creates a macro environment that specifically rewards companies driving technological efficiency. If you are investing in the infrastructure or software powering that AI boom, the removal of the Fed put is just noise compared to the tailwind of his dovish tech stance.
So what does this all mean? Let's bring all these threads together. We're staring down the barrel of a Federal Reserve under Kevin Warsh that is going to be fiercely independent.
Yep, no answering to politicians.
Right. It's going to be messier, reacting to live data instead of relying on dot plots and forward guidance. But fundamentally, it is a regime built on extreme optimism about the power of artificial intelligence to manage inflation.
It is a profound departure from the central planning of the last decade. Warsh is demanding that the market stand on its own 2 feet.
He really is. It means trusting the painful process of genuine price discovery over constant Fed handholding. It means accepting some significant short-term volatility in May for a potentially much healthier, dynamic long-term market.
It does, but, stepping back from all these optimistic projections, this entire paradigm shift raises one massive structural vulnerability that I think the market needs to consider deeply.
Oh, what's the blind spot?
Well, we've established that Warsh's entire dovish justification for cutting short-term rates relies entirely on the assumption that AI will trigger a 1990s-style productivity boom.
Right, that is the cornerstone of his strategy to suppress inflation while allowing economic growth.
Right. So, without that AI miracle, the hawkish dove balance falls apart. So what happens if Wall Street, and by extension Kevin Warsh, is drastically overestimating the immediate impact of AI?
That is a terrifying thought.
What if companies spend billions on AI infrastructure, but it fails to be the significant disinflationary force he expects? If those corporate overhead costs don't drop and consumer prices stay high, his entire policy framework faces a crisis.
You'd be trapped.
Exactly. Does he instantly abandon the rate cuts and snap back to pure aggressive hawkishness? Because if that productivity miracle doesn't materialize, suddenly flying manually without a GPS might lead us straight into a stagflation storm.
That is a phenomenal reality check. If the artificial intelligence thesis cracks, the safety net isn't just gone. The fundamental math of the entire U.S. economy changes overnight.
It really does. It's something to keep a very close eye on as we weather the volatility of this transition. Thank you for joining us on this deep dive. Keep questioning the consensus, keep digging into your sources, and we will catch you on the next one.